if you look at the debt, and then hyperinflation is the only solution, because you are not going to cut entitlements now. So the only solution is printing, which leads to hyperinflation. The cycle goes over from the Roman Empire, from this, from that. There is simply no other solution. For protection from that, you need real assets.
Welcome to Speak Up. I am your host, Anthony Scaramucci. Thank you so much for joining us here on the Wealthy On Network. Joining us today is Sven Carlin. He is a value investor researcher. He's the author of Modern Value Investing, 25 Tools to Invest with a Margin of Safety in Today's Financial Environment. It's great to have you on the show. I want to talk a little bit about the whiplash that's taking place in the markets. And so before we get into anything super specific, let's talk about the macro situation. Is this how you thought the Trump administration was going to go? Did you predict all this? Are you a 5D chess player like Donald Trump? I mean, tell me what's going on and tell me where you think we're all going.
I think it's impossible to predict these things. We don't know what will happen tomorrow when we wake up. But as a value investor, we always look at the fundamentals and the risks. So the fundamentals, if you want to talk about the macroeconomy, I have just looked, and perhaps it's the most powerful compounding idea that I could find, and that is the interest payment on the US debt. If everything remains as is, it will compound and at 8% annual rate. And when I see 8% annual compounding, I know that's something that's going to grow fast. So that would be a key fundamental macroeconomic perspective. And then you can try to impact it with tariffs, with this, with that, but the fundamentals are simply there.
Let's go to your big intellectual mentor, Warren Buffett, right? You love Buffett. You talk about him all the time. You and I have talked about him. I've read your book. I know you love Buffett. He says that this is a declaration of war. Do you feel that this is a declaration of war like Warren Buffett feels, or no?
Well, when you put such tariffs, that's a trade war. But when Trump retreats after a few weeks, then it's more negotiating, trying to get a deal. But that is not how things work in politics. When you're in business, you can go and risk it all on something. You declare Chapter 11 and then you go to the next venture. But when you are with governments and people and the economy of a nation, you cannot really risk it.
So, Sven, I have buddies of mine that I went to law school with that have been USTRs. Mike Froman, who's now the president of the Council of Foreign Relations, was Barack Obama's U.S. trade representative. He has said publicly that it takes 18 months to do a trade deal with one country. We're trying to negotiate 70 different trade deals in 3 months. Do you think that that's possible? Or do you think that that's, I don't know. Are we, I mean, I know we have a 5D or 14D chess player like Donald Trump and stuff like that, but is that possible?
I don't think that the second or third level consequences have been taught before going into this, because there are myriad of factors that you can look at, how the other countries are going to react long term, how it brought uncertainty to businesses, because a business now says, okay, I'm going to wait with investments, and all that are factors that it's practically impossible to contemplate. And then also countries are saying, oh, let's wait with the negotiations. Let's see how things are evolving. Maybe we'll get some other investments that are backing off somewhere else. And so it is just opening Pandora's box with where will this go?
Bullish? You're long-term bullish?
On what?
Well, let's say U.S. stocks.
No.
Okay. Are you long-term bullish on European stocks?
No.
Okay, what are you bullish on anything?
Not really that bullish on just specific niches, like perhaps food stocks that have been beaten down with trade, some commodities, but we are not yet anywhere close. We have seen some volatility in the markets, but we haven't seen any structural pain. We have not seen a recession. We have not seen a recession for 15 years. So give me a proper recession of 2-3 quarters, then trying intervention, then reaction on that. Give me the private equity bubble bursting and things like that. And then I'll start to tilt towards bullishness. For now, if the markets come, if volatility comes, I'll be most bullish on out of the money options for hedging.
So I have a question for you. If you this is more sort of a meta question. This is a meta question. And I'm going to play the devil's advocate here. We have a $35, $37 trillion deficit, depending on how you're accounting for it. There's maybe another $50 trillion of liabilities thereafter, if you're really thinking about the Social Security situation and other entitlements going on in the United States. We have a debt-laden society around the world. We're cheapening our money everywhere around the world. You know that. I know that. You just look at the M2 numbers and so forth. You're a bear on Bitcoin. We've talked about this. You don't like Bitcoin. Do you like gold? Do you not like gold? Well, what would you? I mean, so if I was a doom and gloom person, I'd say, okay, wow, this thing is getting out of control. And I will submit to you, and you can push back on me, but I think if we're going to have a recession, that recession has been exacerbated by the Donald Trump decision making and also the unpredictability of it. You can push back on me if you don't agree with that, but what about gold or what about Bitcoin, given the circumstances that we're seeing?
Okay. So when it comes to gold or Bitcoin, we can call them as hedges. However, I need to have cost-effective hedges. As a value investor, I want things that are there, give me a safety, not that depend on someone paying more for that. So if I buy now Bitcoin, to gain on it, I have to see people buying more of it and pushing the price higher. Similarly with gold. And yes, that might happen in a crash, but might also not happen. And I don't know whether that will happen 3 years from now, 5 years from now, or 7 years from now. Plus, then there is how much money should I put into that? 1%, 5, 10, 20%. What if I put 20% in gold and tomorrow I wake up, it's 50% down? So that is really not a cost-effective hedge. A business that has a P ratio of 10, that has, a food business, a dividend yield of 5%, protects me from inflation. People are going to eat no matter what. And over time, I should do well, for example. So I prefer, as a value investor, value, certainty, and not things that go up and down depending on whims of other investors.
Okay. All right. I'm going to keep...
But I'm not saying it cannot happen. I read your book, so I know you're big on Bitcoin. I'm not saying it cannot happen. I'm not saying Bitcoin cannot go to 1 million. It can. I'm just looking at the risk and reward and how do I position myself in a life cycle of 40 years of investing.
Okay, well, Sven, now that you said that Bitcoin could go to 1 million, we're ending the interview. It's very nice to talk to you today. No, I'm kidding. I want to talk about investor sentiment and psychology. We've had essentially a roller coaster going on, I think, right? We're oscillating from fear to greed back and forth. What signs are you seeing in the investor behavior right now? And what do you like about it or not like about it?
So when you look at behavior, especially of our humans, it's determined by what has happened recently. So over the last 15 years, we have had a Fed intervention at every hiccup. If there is a recession, we will print money. The last issue was the pandemic. You were sitting on your couch, you were getting money to play with Bitcoin, with whatever. So everyone expects that whatever the hiccup next is, there will be more money printing, there will be lower rates that will push stocks higher. So the predominant mentality is just buy the dip no matter the price.
Okay. That's been the right. You mentioned 40 years you've been an investor. Me too. Sort of hard to believe. That's been the right thing to do, though. And Warren Buffett said that the smartest thing that he did was believe in America, buy America in dips. Obviously, you and I know he very famously bought into things like Goldman Sachs and Bank America, GE during the 2008 financial crisis, and they were prescient. Is that gone? Is that over? Is America over?
Let's put it into this perspective. I think America and the S&P 500 has the greatest businesses out there. No question about it. But if I have $1 million now and I put it into the S&P 500, the dividend yield on that is 1.4%, which is 14,000 on my million. And all being the best, no recession in the next 10 years, that dividend yield with the buybacks, with the growth, with everything, will likely grow on average 6%, 6-7%, which means that in 10 years, at best, I will have 28,000 per year. 14,000 now, 28,000 in 10 years. With the Fed printing money, with low interest rates, with this, with that, it will not be worth much. So the problem is not the businesses, and that's why also Warren Buffett sold. The problem is just the price. Because if I'm paying a P ratio of 25, 30, it's simply too much downside for the potential upside of just doubling my small dividend yield over a decade.
Okay, well said. And I think it's a really important thing to emphasize, and I think this is the reason why people like your business and your investment philosophy, Sven, because it's very common sense. Let's go to the U.S. trade tussle with China and these sweeping tariff decisions. And let me make Donald Trump's case for a second, and let me ask you if the policy that he's implementing is going to be reaching the outcome that he would like. So Donald Trump is making the case that there's been an uneven or unfair trade relationship with China for 3 decades, a result of which they've plundered the U.S. We've lost manufacturing. We have a very large trade deficit with them. There's a trade imbalance, and this trade imbalance needs to be corrected, and we need to bring manufacturing back to the U.S. So the way to do that is we're going to have massive tariffs, a result of which it will incentivize people to build factories here in the U.S. so they won't have to deal with the tariffs. Is that strategy something you agree with? Is that strategy something you think will work? Is that strategy, evaluate the whole situation for us?
I think, as we already discussed, there is first, second, third level thinking, and then you really need to play 100-dimensional chess here to understand what will be the consequences of this situation. But when I look at things, you want to bring manufacturing back to the US, but the US has a natural rate of unemployment. It's 4%. Where are you going to find all these people that will do those jobs? If you go to China, if you look at those factories, those are Chinese mentality factories. You cannot really transfer them to the United States. So there are not just, I'm going to increase the price through tariffs and everything will change. There are so many other things that are simply from the culture, from this to that have to be thought about, from finding that labor that is simply not available at these costs.
If you were the dealer in a card game and there was a trade war between the Chinese and the United States, who has better cards?
I think that the Chinese can endure more pain.
Okay, tell us why.
So I have a Chinese friend, and his parents grew up on sweet potatoes in the 1970s, came to Italy with $50,000 given from 10 families from that village. They turned those $50,000 into, I think, 500 million through importing Chinese stuff into Italy. They have two kids, both have finished Cambridge and Oxford. And now that guy has received the second round on Sequoia financing, and his 10% stake in his Chinese startup is worth 100 million. If I look at that work ethic, that ability to endure pain, China has no issues with ratings, no issues with next elections. They have their own mission, so they can just simply wait it off. Trump will be gone, China will still be there, and they can endure the pain, plus work on the other 86% of the global economy that's not related to the US.
Okay. I want to switch it to Europe, if you don't mind. So Europe is sort of the flyover situation for the Chinese and the Americans. And of course, the Chinese are smart long-term thinkers. They're going to go reach out to their European potential counterparties and see if they can do different trade deals. How do you think Europe is positioned, and how would you position Europe if you were their trade czar?
Now, first, from all the free powers in the world, when you look at Europe, Europe is the weakest. So demographics are terrible, and economic growth has been non-existent for the last decade. And there is such a sluggishness in Europe. We don't have the tech businesses pushing us forward as the US, and we don't have the growth that China has. So there might be some benefits, but that is not something long-term or durable that it will revive the European economy or help with debt payments or help with the aging of the population or things like that. So I don't expect miracles from Europe.
Let me ask you this. Has Trump woken them up a little bit? Has he said, okay, listen, you got to get more defense spending? Will they do more capital expending? Will they do more venture capital expending? Or will they, are they heading on in a slippery slope that there's really no way to get out of?
In Europe, there is more and more government investing. So maybe governments will start spending more capital, but the return on that capital, whenever governments spend it, is questionable. Everywhere I look here in the south of Europe, there are so many projects financed by the European Union. But if you look at the economics of that, apart from giving jobs to the people making that, there is no real economic long-term return. Or it is very, very small, and they are happy with that small return because they can print free euros.
Okay.
As they have been doing over the last 15 years.
Let me ask the question this way. You have a great ability to analyze data. There's a economic dashboard. You're flying your plane, which is your portfolio. And there's an economic dashboard in front of you. And right now, I think you see some cautionary lights and some sell signals. I think you're bearish on a lot of things. But what would have to change to make you bullish? Meaning, where would PE ratios have to be? Where would GDP growth for Europe and Asia and the US have to be? Where would multiples, PE multiples have to be, where that dashboard says, okay, there's clear skies ahead. This is a buying opportunity.
So there are some pockets where the multiples are around 10. So you have this company in the US, Archer Daniel Midland. So if you have eaten something today, some of it likely came through them. Mm-hmm. They are now paying a 4.5% dividend yield. Food has always a cycle. So those stocks go up and then those stocks go down as food prices decline. And now we are in a food downturn cycle as we have had 2 years of inflation. And there the average long-term cycle P ratio is 10. The global economy will grow 3%. we have 7, 8, 9, 10 billion people, so the business will grow over time. They have been increasing their dividend for 51 years consecutively, and I can buy that at a P ratio of 10 and a dividend yield of 4.5%. With all the growth from inflation because food commodity, so I'm protected there. So I have these small pockets that I would say, okay, this is now already interesting. I'm searching for value where I cannot lose much and I have a good return. So if I compare it to the S&P 500, it is a good business, good return, but the risk is simply too much or for a lower return. That's it.
I guess what I'm, I don't know, maybe I'm getting old. Maybe I'm getting, maybe I'm overly recognizing a pattern, but I'm going to push this on you and I want you to react to it. M2 is swelling. The Fed's got movement. It could go 200, 300, 400 basis points. The Fed could implement again, we know this, quantitative easing. At some point, the bubble will burst, but you've said we're in a super bubble. Maybe we both know that sometimes a super bubble can become even a bigger super bubble.
They're going to print. I have no doubt about it.
So you agree with it. Okay, so let me just push back just from a timing perspective. If they're going to print, and I think you agree that they're going to print, and I agree they're going to print, which is why I'm big on Bitcoin, and I understand your Buffett reasons why you're not into Bitcoin, so we don't have to debate that. But if they're going to print, won't that provide risk-on opportunities in the stock market?
Yes, but if they delay that printing for a year, I can be 50% down with the stock market because of inflation or things like that. So it's always about when the risk is at the bottom,
right, so you're looking
and
at the
returns are high.
Okay. All right.
So the best option, if I have $1 million S&P 500 portfolio, at this moment in time, maybe I just wait 2 weeks for the volatilities to settle, for Trump to go on vacation so that the VIX is below 15. And then I look, okay, I will put 1% of my portfolio into some out of the money options. So if all hell breaks loose, I am protected from the downside. If the Fed prints and stock double over the next 5 years, I take advantage of that upside. That is the best value investment idea I can come up now. So I need insurance and I need to have the upside from being long.
Okay. Well, I'm going to give you the last word. What is the last word, Sven? What should I do?
With your Bitcoin?
No, not my Bitcoin. You and I disagree on my Bitcoin. What should I do in general? Should I get in a bunker? Should I get the cash? What do I do?
I think that it depends on the strategy. First, expect anything. And when you go with an open mind, okay, the stock market can be double in the next 5 years, but it can also be 50% lower. How does that affect me? I don't like the 50% lower. Okay, how much does it cost for me to be protected on that? Okay, if it can be lower, is it better that I go into cash like Warren Buffett? But that is again a risk if the Fed starts printing heavily. So I don't like Warren Buffett's cash position, but then he's so big that he cannot insure it with options or things like that.
All right, but you're the most. I love talking to you because you're like the most realistic of all the people I talk to. But there is a scenario where we go up 15, 20%. Not talking in real terms. I'm just talking the stock market could melt up as a result of all this money printing, right?
Look, I was born in the former Republic of Yugoslavia. So when I was a kid, when I was 6 years old, we had hyperinflation, which means I was a billionaire when I was 6 years old. You are talking 15%. I can tell you 150%, 1,500%. If you look at the debt, and then hyperinflation is the only solution because you are not going to cut entitlements now. Mm-hmm. If Trump comes and says, or whatever US president says, okay, people, I'm going to cut entitlements by 15% now so that we solve the debt issues, he's going to be out of office tomorrow on some kind of impeachment or something. You will invent something.
No, I understand.
So the only solution is printing, which leads to hyperinflation. The cycle goes over from the Roman Empire, from this, from that. There is simply no other solution. For protection from that, you need real assets. It can be businesses, it can be land, it can be
real estate,
homes, things like that.
Well, listen, you've been a terrific guest today, and I love talking to you. And I owe an apology to our viewers and listeners because I didn't get to their questions. And so I didn't do that, Sven, because I enjoyed talking to you. And I was the one that wanted to push you today. But we'll get you back on, and we'll get our viewers and listeners to ask you questions as well. But thank you so much for joining us today on SpeakUp. I thought it was you're one of the brightest minds out there. I know you have a terrific business, and I wish you great success. Thanks you again for joining us on SpeakUp.
Thank you. It was a pleasure being here.